Hi, my name is Sandeep and I'm the policy analyst here at Minance. So today we're going to talk about debt funds. The reason we're going to talk about debt funds is because if you're looking for some sort of a short-term investment, which is just as secure as a bank deposit, but you want higher returns, then you should probably consider debt funds, short-term debt funds in particular. Now, debt funds fall under the category of mutual funds, and they usually comprise of corporate bonds and government bonds and other money market instruments. But the thing about short-term debt funds is that they don't necessarily respond in the same way that long-term debt funds do to policy changes and inflation changes and interest rate changes. They are less volatile and less sensitive to these changes. Now, short-term debt funds in the near future are likely to give you more returns than long-term debt funds, and we believe this because of three main reasons. Firstly, government expenditure is likely to increase. We know this because this is what the government has stated that it's going to do in recent times, and also given the fact that they had performed poorly in the recent Gujarat elections, specifically in the rural areas. So we know in the budget, or we can expect in the budget at least, that the government will increase expenditure in rural areas and will probably not keep its target to below 100% for this financial year anyway. Given this, when government expenditure increases, this tends to add an upward pressure on yields, on bond yields that is. And when bond yields go up, we know that bond prices go down. And these effects are generally felt in the long term. Secondly, inflation is projected to rise. The RBI has recently increased its projections from what it had before to about 4.3 to 4.7% for the next few months. And when inflation rises, investors generally want higher returns on their investments, which means they want bigger yields on their bonds. Of course, bigger yields, once again, leads to lower prices. And since inflation is expected to rise, we can expect bond prices to go down. Once again, inflation is something that will take a while to be felt, so it is a longer term effect. Finally, the RBI is unlikely to cut its policy rates, primarily because it wants to keep inflation in check. That is its priority. Now, we mentioned that the government expenditure is likely to increase and that inflation is likely to increase. And government expenditure, when it does increase, tends to also cause a further increase in inflation than it normally does without government expenditure. Now, people want the RBI to cut its policy rates, which will be good for bond prices as it usually lowers the yield. But given that the RBI really wants to keep inflation in check, this is unlikely to happen. In fact, if anything, the RBI will probably increase its policy rates in order to keep inflation in check. Now, given all these things that we've just mentioned, we believe here that short-term investments in debt funds will probably give you higher returns than bank deposits. Bank deposits right now give you about 6 to 6.5%, whereas if you find a good debt fund to invest in, you can get upwards of 7.5%. Thank you so much for watching. Be sure to check out the link in the description to know more about debt funds and what kind of debt funds to invest in. That's it for today.